immediately to steps and became Gulfport and got my law degree. I practice in the areas of real estate, tax, corporate law, estate planning, probate, and I focus on small businesses. That's my passion. I started my own business about 12 years ago, and I would never work for anyone again. And I do a lot, both accounting and law for my clients. So they get to save money, but they also get the liability protection that small businesses need. So the goals for today. Number one, I want to save you money. There's a lot of ways to do that. Number two, I want to demystify numbers. I remember when I was in law school, and I'm surrounded by these frighteningly intelligent people. And we're in our tax class in the second year. And the professor started writing numbers on the board. And immediately there was panic. Everyone's like, wait, we don't have calculators. And he was using numbers like 1,000, 3,000. And there was this panic because a lot of these people didn't have any kind of a numbers background. They went pre-law and then they went right into law school. And that's terrifying for someone. So I want to take the mystery out of something. As a small business owner, I think you really need to know where your money's going and how to save it. And there are shortcuts you can take to keep as much as possible in your pocket. Also want to get you thinking creatively because there's a lot of, like I said, shortcuts that you can take. And you probably already noticed I speak really, really fast, especially when I've had a lot of caffeine. So feel free to slow me down, say, wait, I have questions. Can you clarify this? Because I'll just breeze right on through. Okay, so what can we deduct? Number one, you can deduct your accounting fees. For your tax return itself, for any bookkeeping you do, for payroll, anything you're paying your accountant for. Number two is your advertising, and that's a big one for you guys because you've got apps, you've got social media, you've got signs out there. So keep track of your advertising. Answering service, most people don't use that anymore, but actually there are people who are using virtual offices with someone answering their phones. So bank charges, people forget about this a lot. If you're getting charged on your business bank account, those are deductible. Your commissions, your broker fees, anything that people are taking out of your paychecks, those are deductible. Dues and subscriptions, all these memberships you have to have for your company, those are all deductible. Your gifts for your clients, those are also deductible. Janitorial fees, if you're cleaning up the house you want to sell and you have some people come in and clean it up and need it or whatever, that's all deductible, as well as for your home office. So we'll talk about that a lot. Your legal fees, your license for sure, that's expensive, and your meals. Now that's an interesting topic of discussion right now because there's been a change. First of all, they have to be work related. If you take your client out to dinner and you talk about how you're going to market their house, that business meal is deductible. If you take your friend out to a restaurant, it's not. You have to actually talk about business with a client. It doesn't include your lunches during the day unless you're eating with the client. You have to be present for the meal. You can't send your client and their spouse off to dinner and then deduct it. You have to be there and you have to document it. So in the back of the receipt, you're going to want to say, met with Mr. and Mrs. Jones. We talked about selling their house on York Street, and then save that receipt because the IRS is going to want you to document that you were actually talking about business and who you were talking about with. What kind of meals are deductible? Well, if you take your client and you just stop at Publix with your client while you're out looking at houses and you buy 2 subs and eat them together, 50% of that meal is deductible. The theory being that you buying them lunch is deductible, but you buying your own lunch is not. So you can take half of that. The same with meeting them in the work cafeteria or going to a business conference. Anytime you're traveling for business, your meals are 50% deductible.
Hey, Diane, quick question. So I read that up until 2023, due to the pandemic or something. Oh, okay. The next slide was actually my question.
Yeah.
Oh, all right. Okay, I just saw it.
Exactly where we're going with this. Because of the pandemic,
okay.
people weren't eating in restaurants. So Congress decided, okay, we're going to give them an incentive to get out there and eat in the restaurants. We're going to make restaurant meals 100% deductible. That's only for 21 and 22. If you take your client out, have a nice dinner in Burns, 100% deductible. That's the first year. Right now, this is what we're confronting. And actually, the reason I found that was because I was preparing for this class. Because I hadn't done any tax prep on the tax law changes yet. And I was kind of floored when I saw that. Of course, they have to go on and define what a restaurant is. It's a business that prepares and sells food or beverages. And that's interesting that they say or beverages to retail customers for immediate consumption, regardless of whether the food or beverages are consumed on the business premises. So that would imply to me that if you get takeout from Olive Garden and you eat it at the client's house, it's 100% deductible. You got it from a restaurant, even though you didn't eat it there. But they say or beverages, which would make me think if you had drinks at Olive Garden, that would be 100% deductible. But then they say bars aren't. So it's going to be an interesting area for your tax preparer to kind of flesh out. And the reason I'm bringing that up is when you're getting all your tax documents together for your tax preparer, you want to separate out your restaurant stuff because that'll save them a lot of guesswork. Just so you know to be prepared for you. These are the 50% and these are the 100%. But that's interesting. So get your clients out there to restaurants. Also 100% deductible are company parties and your open houses. If you put all the appetizers out for people to eat at the open houses, those are 100% deductible.
I mean, what happens if you entertain, because of COVID, we entertained a lot at home because we didn't want to go out? Is that allowable or not? Is that considered,
If you encourage.
because it's less expensive, number one, if you said get burned, it's $200 a pop, right?
Yeah, if
With
you
your
had
home.
your client in your home and you put a meal together for them, that would be 50% deductible. The way to get the 100% is to go to the restaurant.
Got it, thank you.
Sure. Any other questions?
I have a question.
Sure.
And I don't know if you've already sent it. Could we get a soft copy of this afterward?
I know the video is going to be out there on Keller Williams' YouTube channel,
Right.
and I will put it on my Facebook page as well. But yeah, I can certainly print copies. It's no problem.
Or just, yeah, even just an email copy would be great.
Sure, absolutely.
Thank you so much.
So how to document? Again, on the back of the receipt, write down where you went, what you talked about, who was there at the dinner. There are receipt scanners that will save that for you. I don't know if you notice with receipts, but after a couple of years, they go completely white. All the ink fades away. So if you're relying on that and you get audited 4 or 5 years down the road, they might be blank. So you might want to think about some kind of receipt scanner where you can just stick them in there and it scans them in there and you can throw away the originals. There are also expense trackers out there, and I have not used any of these, but I just look in Zoho, Expensify, Raidu. So I'm sure there's plenty to compare.
I've used Expensify, and what I like about it is that you can just scan it with your phone, but you can also track your miles.
Oh,
So you can do beginning and end mileage, and
that's
it'll
perfect.
track it for
Do
you.
they charge you for it?
You can do an upsell, a buy on the app, and it's not much money. It's like, I don't know, $10 a year or
Oh,
something.
that's great.
But at the end of the year, and you should have seen a few of these, is that you could just print that out too
Yeah.
at the end of the year. So then you can categorize. I'm not that.
That's fantastic.
Yeah, I'm not that good at it. So. But you can do it.
I'm glad. Okay, what is no longer deductible is entertainment. And that is also a change. Used to be you could take your client out to a football game or a concert or the country club and deduct half of that. Now you cannot. None of it is deductible. I'm not sure what the logic is behind it. I guess people were abusing it. But it's officially gone from code. Okay, additional things we can deduct. Your office supplies. If you are an S corp, your salary to yourself is going to be a tax deduction. You can deduct your postage, your delivery. You can deduct printing charges, copying charges, repairs and maintenance, again, at the client's house or in your home office. You can deduct a security alarm camera, storage fees. If you hire any subcontractors, that's deductible. You can, your photographers, all your on-site service people like your Supra, your key service, that's deductible. Any supplies for whatever reason, if they're business related, they're deductible. You can take taxes, that includes sales taxes, payroll taxes. You won't have any taxes. Your telephone, okay, let's talk about that. If you have your cell phone, one cell phone like most of us do, and you're using it part business and part work, it's up to you to find a way to allocate that. So you can say, well, I think it's 50-50. Most of half the time I'm on work, half the time I'm personal. Or maybe it's 60-40, 70-30. That's really up to you to decide how to allocate that out. But you want to have some basis to document that. Because if you take the whole thing and you're using it for personal, then you risk a red flag. Your travel, it has to be outside of the immediate area. Like I think it's like 100 miles. If you travel to Miami for a conference, that's deductible. Keep track of your travel expenses. There's a little bit more on that later. And your uniforms. Uniforms, unfortunately, don't include suits. If you have a uniform, it has to actually have a company name on it, and that's the only way you can deduct it.
So anything with your logo or your name on it, your company name on it?
Yeah, like mechanics have where their garage logos, those are deductible. So that actually does have to be a uniform, unfortunately. Okay, business travel expenses. It must be work-related, it must be ordinary, and it must be necessary. If you go to Miami for a conference and you decide to go to the aquarium, that's fine. You can't deduct the aquarium, but you can do personal things while you're on this business trip, and it's still deductible. That includes your airfare, it includes your taxis, your Uber. If you take your own car, those expenses are deductible. Your lodging while you're staying there. They actually threw in dry cleaning and laundry, which is kind of nice. And then keep in mind those meals. If you're there for business in a restaurant, 100% deductible. If it's not a restaurant, you're still at 50%.
Dry cleaning only counts if you're traveling,
Mhm.
so you can't do dry cleaning.
Unfortunately.
Unless you have a
First rule
uniform.
in tax law is that it's not logical. It's all based on who happens to be making the laws at the time. There is actually a deduction in there for pregnant pigs because some congressperson happened to have pregnant pigs and wanted to expense them out, so they throw that in the tax code. So don't ever look for logic in tax, you won't find it.
So travel,
Okay, so let's talk about your car. You have two options when you're using your car for business. You can track the actual expenses, or you can take the standard mileage expense deduction. It really depends on how much you're using your car for business. If you live here in downtown St. Pete and you're meeting your clients here, you might not have a lot of miles. Depends on, how often you're running out of the area to go to different properties. So you are allowed to choose whichever one is beneficial to you. You can take a higher one. But once you pick a way to go, you're stuck with it. You can't flip-flop every year back and forth. You have to stick with one way. Actual expenses that are deductible. Your gas you put in the car, your repairs and maintenance, your car insurance, parking and tolls, the tags on the car, your lease
The
payments.
entire lease payment?
You have
What if you
to,
got two cars?
whatever car you're using, you're gonna have to allocate among personal and business. If you're using your car just for business, it's a lease car, then yes, you are able to deduct part of that lease payment. And also depreciation. I don't know if you know what that is, but wear and tear. The IRS says that if you buy something like a car or electronics that is meant to last more than a year, you can't write it off in the year you buy it. You have to depreciate it over a number of years. So if you spend $5,000 on office equipment and it's meant to last 5 years, you get $1,000 a year expense on it until it's gone. But when you're using your car, it's depreciating, it's losing value. So they're gonna factor in how much you paid for the car, how much you use it for business, and they're gonna get you a depreciation deduction. Your alternative is to use the standard mileage rate. For 2021, it's 56 cents a mile. So you just take all the business miles you put on it, multiply it by 0.56, and you have your deduction. But then you have to allocate for business and personal. No, that's right. Okay, that was business mileage. And for 2022, it's 0.585 per mile for business miles. You have to have written proof, and that's where Bunny's Expensify comes in, because it will. I used one called Mile IQ for a while, and my phone just every time I drove somewhere, my phone would track it, and at the end of the day, it would say, "You had 3 drives today. Do you want to classify them now?" And I could say, oh yeah, personal, no, this one was business, and then you can enter information. It's pretty easy to use. You can wait till the end of the week and do them all at once, but it will do a PDF for you at the end of the year, which is written proof of where you are. And like she said, there are plenty of those tracking apps out there. Home office. Before I start, are there any questions? Anything not clear?
No, I have a question, really quick. So last year, in 2021, I purchased my car cash. It was used car cash. So what expenses right now do I use towards the purchase of the car, since people are doing interest? So is it just that specific tax dollar amounts?
Whatever you spent for the car, and then you're gonna calculate how much of it you used for business, and you're gonna take one of those 2 deductions.
One of those two.
So the car itself is gonna be spread over probably 7 years. There's a different classification for everything. There's 3-year property, 5-year property, 7-year property, 15-year property. Rental properties are over 26 years. So, it's, like I said, no logic in tax law.
Okay.
With the gas, right, is it better to just write off the gas as you pump it or do the mileage? That's what I'm.
It's gonna be different for everyone.
Yeah.
What you wanna do is get your tax preparer everything.
Yeah.
You wanna give them all the actual expenses, but then you wanna give them the mileage too. And they can figure out which number's better for you and tell you why they chose that.
Yeah.
So that's kind of my goal here, is to get you, so you know exactly what paperwork to take in, so that your tax preparer can help you most.
Question, so just so I can hear it in my head. So did you say that if you pick one side or the other, you have to stay with that? Is that for infinity? Now I did it last year, I gotta do it the same way
For
this
that
year?
vehicle, yeah. Unfortunately, you can't say, oh, well, I had a lot of actual expenses this year, so I'll take that one. But next year I'll take the standard. They won't let you do that. Once you put the car into the business, not title wise, but once you start using that car for your business, you pick away and you stick with it. And you want to pick the one that's going to benefit you most.
But I have a quick question. Is it the gas or the mileage, or all those expenses or the mileage?
All those expenses,
Or the mileage,
Or the
not
mileage.
just gas.
Mhm.
Okay.
so give them everything.
So I saw in there it said tolls. So if we're doing the mileage, we cannot also in addition add tolls.
Actually, you can't. Tolls are, parking and tolls are deductible regardless of which method you use.
Okay.
So yeah, you have a tax return,
Yeah.
only on the actual.
Oh, yeah, okay.
It's the only one, I don't know why they singled that. Your home office, okay. So you have an office that you use at home, mostly for business. How do you write that off? Let's say you have a 1,000 square foot home and your office is 100 square feet. You're using 10% of your home for business. So we can take 10% of homeowners insurance, 10% of property taxes, 10% of any repairs and maintenance needed, 10% of utilities, all your utilities, including landscaping, 10% of your mortgage interest, and including points. And that's important now, because most people aren't taking itemized deductions anymore, so you're not writing off your mortgage insurance. Or your mortgage payments. This is a way to take some of those. Used to be you had to allocate, the lower your itemized deductions in order to take that mortgage interest for your office, but now you don't have to do that. If you do any specific office build out, you add in a whole new custom cabinets and everything for your business, you can write that off 100%. You probably have to depreciate it over time, but it's 100% deductible. Depreciation on your home, just like on your car, ordinary wear and tear, you're able to take that. And if you're making rent payments, you can take 10%, go ahead and write that off as well.
What if you park the car in the garage where you work? Do we write that off as well?
Absolutely.
What about cleaning? Okay,
10%.
okay.
Speaking of utilities, do they have to be under your name?
If you're paying them, no.
Okay. So pretty much anything on here doesn't have to be in your name as long as you're paying for it and you have the receipts and the proof.
Except for the mortgage interest, that has to be in your,
Okay.
the mortgage would have to be, they won't let someone who's not on the mortgage claim that. They're very specific.
No, what if you own like, never mind, I don't have a mortgage, like I own my house like free and clear,
Okay,
so, but it's, yeah, okay.
I calculate out your home office space as a percentage of the whole, total square footage and take that percentage. It usually runs between 10, 15, 20%. I have seen people try to write off 70% of their house. They left themselves a bedroom and a bathroom. And immediately they got slammed by the IRS. And, I thought it was excessive. It wasn't my client, it was someone else's client. And when I mentioned that seemed excessive, he got very irritated with me. So, have you seen their house? They have file cabinets in the living room. Okay. Don't do that kind of stuff. There's a really good reason why you don't do that kind of stuff, but it is a red flag. You're taking these huge home office deductions. It's not going to fly. So now we've come up with, you have to report your income, and we've gone through all the expenses that you have. If you put those on a piece of paper, that's called a profit and loss statement. I know there are a lot of people, even people high up in the corporate world, who have no idea what a profit and loss statement is. And it's something you should know for your business. If you are ever going to try to get a loan for your business, they're going to want to see a profit and loss statement. So for 2021, you would put gross income, whatever that is, you would list all your expenses and total that up, and that would give you your net income. That's all a profit and loss statement is. You can run one for the month, you can run one for the quarter, you can run one for the entire year, it's up to you, but they're going to want at least 2 years of those. Your net income is going to be what's taxable to you. And there's something also that came out 2 years ago that's kind of interesting. They came up with what's called a QBI deduction, qualified business income deduction. And what that says is whatever that net income is at the bottom of that profit and loss, you are possibly able to take a deduction of up to 20% of that number on your personal return.
Do that statement again?
Okay. Let's say you have $200,000 in gross income in your commissions. You add up all your expenses and it comes to $100,000. Your net profit is $100,000. You could be entitled to an additional tax deduction on your return of $20,000 because of the QBI deduction.
What is QBI?
It means whatever that net profit is, you get a deduction for 20% of it. Now, there are restrictions. People at super high levels can't take it. They banned people like rock stars, things like that. There are certain professions that can't take it. So your tax preparer will literally qualify that. But the reason I'm telling you that is because I want you to, number one, resist any temptation to pad your expenses. Because as you bring that net profit down, you're bringing that QBI deduction down. So report your expenses as accurately as possible. Don't use round numbers. Don't say I had 5,000 miles. You didn't have 5,000 miles. and they know exactly what the number, if you multiply the standard deduction by 5,000, they know exactly what that expense is, so they're looking for it. Be as accurate as possible. Let your tax preparer do the heavy lifting for you. Because a $20,000, I mean, when you're filling out your personal return, they're automatically giving you at least a $12,005 deduction. You could get an extra 20, and that's big. It's been saving a lot of business. Everybody's getting refunds now because of this. So I hope it stays around, but it's something you need to know. But as people are learning about this, 2 years ago, we had no idea what this even was, and we've been learning, and there's no really guidance out there from the IRS on it. But as people get used to this, they're gonna do the opposite. They're gonna start not reporting expenses because they want a higher deduction. So, yes, I made $200,000 last year. Nope, I didn't have a home office deduction. I didn't pay rent. I didn't even have a car expense because they want that big deduction. So you want to be as accurate as possible. Both of those are going to be huge red flags to the IRS. So not that anyone would have their
How do
expenses.
you know that, how do you know when you qualify for that?
Your tax preparer does.
Okay, good.
There's a thing
Like
like
a really good one.
It's kind of a complex little calculation, but
Okay.
just know that it's there and know that you reporting your expenses is affecting that. And you could be hurting yourself by over reporting things. Not only is it a red flag, but you're taking money out of your pocket. Okay, now we talked about what a profit and loss statement is. Income, expenses, net profit. Here's the flip side of financial statements. And if you're gonna get a loan, you need to do this. It's called the balance sheet. Number one is gonna be your assets that the company owns. Your checking account, all those things that you bought that are meant to last more than 5 years, those are gonna go over there until they're depreciated. If you own real property, if you own land, if you own patents on things, those are all gonna be assets of the company. The next thing is going to be your loans. If you loaned yourself money, you loaned your company money, that's a liability the company owes you back. Your credit card debt, bank loans, those are all gonna be there. And finally, the bottom section is what your ownership interest in the company is. Your net income is gonna flow through there. And I'll show you how this works. We rely on what's called double entry accounting. So one number is gonna go in two different places. Every transaction is going in two different accounts. So let's say I loan my company to get started up. I loan my company $10,000. It's going to go into the liability section as a loan that the company owes back to me. But it's also the money's going to go into my checking account, which is an asset. Does that make sense so far? Okay, questions? Okay, now the company is going to take some of that money out of the checking account. It's going to pay $1,000 to rent a space for the month. And it's going to pay $500 on advertising to get some clients coming in. So the checking account is going to go down $1,500, and we're going to get two expenses of $500 and $1,000. Make sense? Okay. And this is probably, but you're actually learning bookkeeping right now, so it's basic. I mean, you'll see where I'm going with this. Just bear with me. So now the company is going to spend another $2,500 on furniture for the office and electronics. The money is going to come out of the checking account and it's going to go into that section called assets for furniture, fixtures, and equipment because the company now owns $2,500 worth of stuff. Now, all of a sudden you get a call, you earn commissions, $5,000. That's going to go into the income section for $5,000 and it's going to go into the checking account to raise your checking account balance up $5,000. And the owner is going to say, well, I don't want you to pay me back that whole $10,000. I'm going to put $1,000 of that into my stock account because I want to have equity in my company. I want to have an ownership interest. So that's going to take the money, reduce the loan liability that the company owes to the shareholder, and it's going to go down in his capital stock account. And where does this all end up? Here's your profit and loss. There's the $5,000 that you earned as income. There's your advertising and your rent, totaling $1,500. And your net profit down at the bottom for this month is $3,500. Make sense? And here's the balance sheet. You have $11,000 in your checking account now. You have $2,500 in equipment. And you owe $9,000 to the shareholder. So the assets minus the liabilities is $4,500 on the balance sheet. On the equity side, you have $1,000 in capital stock, and you have $3,500 in net income, which is also $4,500. These two accounts will always equal each other. And that's as complicated as bookkeeping gets. So if you go to the bank this is what they're gonna want. They're gonna want not only your income and your expenses, but they're gonna want your checking account statements. They're gonna want any loans that are outstanding. They're gonna wanna know how much money you've earned to date and how much you've left in the company. All of this is important. And based on this, I would say this looks like a pretty good candidate for a loan. If this has been going on for 2 years, then they don't have a whole lot of debt, it's just to the shareholder. They've got plenty of assets that we can draw on if we need to. The income's positive. The owner has put his money into the company, his ownership as stock. So I think that might get you a loan. Questions? No.
So,
You're all still here.
what all is being provided to the CPA for the easiest way as a new agent or an agent that just I went from this last year to an LLC. So everything is in my own accounts, but I'm not in like QuickBooks or Quicken to like put everything in spreadsheets.
Right, and that's exactly what you want to do. That's exactly what I do.
It's put in spreadsheets.
Bookkeeping used to be a really big thing where you would hire somebody to keep the books for you, but because of the banking changes, it's really not necessary anymore, in my opinion. And don't get me started on QuickBooks.
No alcohol.
What I do is I usually go in every month and just check through my online bank statements to make sure that there's nothing missing or nothing erroneous. I have a business account and I have a personal account. At the end of the year, I go in and I search for all the transactions from January 1 through December 31st. And I download all of those into Excel, one big spreadsheet. Then I sort them by debits and credits. I do a sort A to Z on that column, and it puts all the credits together and it puts all the debits together. The credits are going to be all your commissions, all the deposits you've made into your account. And I move those to a separate page. And then I take all the expenses and I sort those by vendor. And it will put all the Duke Energies together, it'll put all the Walmarts together, everybody you're paying, it'll lump them together. And then you just go in and add subtotals and you're done. That's your whole year in a profit and loss. You hand that to you email that to your tax preparer, they will love you. Because it takes literally an hour versus you going in there with a box of receipts and then having to sit there for 8 hours putting things in place. They're going to want your credit card statements too, if you have those. If it's possible to download those too, because it will save you a lot of money in tax prep.
Right.
And it's painless. That's a very good question.
So do you have open slots available for?
Oh yeah. Absolutely. Feel free to call me anytime. I never charge for talking. I just made it a rule because I don't want people to think that they can't afford to talk to a lawyer or they can't afford to talk to an accountant. So you can email me with questions, we can go for coffee. The clock is not running. I just don't do that. If you hire me to do something, if you hire me to prepare your tax return, I will just charge you for that return. But all the back and forth chatting on between us will never be billed to you.
Do you give suggestions on when we need to decide if we need to be an LLC or an S corporation?
That was in the first class.
Oh,
Yeah,
in the first class.
It's
Okay,
on
I'm
there,
sorry.
it's on Keller Lily's YouTube channel. If you
Okay.
Google my name, it'll come right up. I haven't had the nerve to watch it yet.
No, thank you for letting me know. I didn't realize that.
Yeah, because that's, everybody has that question. I want to know, do I need an S corp, do I need an LLC?
Right.
You know, it's, and there's a lot of things to consider before you do that. And unfortunately, a lot of people ask somebody who doesn't know, and, oh yeah, my brother-in-law's mailman says you need an LLC, and then they end up getting in a lot of trouble. So make sure you talk it through with a professional and make the right decision for you. And you want to wait to that point where the expense actually justifies it. You know, once you're first starting out, it's you really don't have a whole lot of cash to throw around. But once the commissions start rolling in, it's a good time to line up for questions. These questions. That's it. Oh yeah. I want to do one more part in this series, and I want to talk about retirement planning for your small business. Because most of you probably aren't putting anything away. It's something you want to think about while the commissions are rolling in. And it also factors into that calculation with the net income and the QBI deduction. Because when you're taking money out for your retirement, you're reducing that QBI deduction down.
Oh.
So it's an intricate little puzzle, and I'm working with a financial planner right now to figure out how to. My name is Dianne. Oh, stop. But yeah, I'm working with a financial planner because there's got to be a formula for that. You know, if you put this much away, it's going to reduce it's going to impact your taxes this way.
Yeah.
To be able to give my clients an option of how much they want to put away. So to maximize investments, but minimize taxes. It's important in their linked right now.
Yeah.
So that's going to be the next series, and I'll probably have the financial planner come in and talk to you the rest.
Oh, that'd be great.
Yeah.
Thank you.
You're very welcome. That's it.
I have a really simple question if you have a moment.
Sure.
In 2020, I lived in South Africa, sold property in Georgia, but was also a Florida resident. Where do I get taxed?
Well, you have to file wherever you earned income. So if you earned income in Georgia, you have to file in Georgia. But we don't have income tax down here, so you're gonna file a federal return and you're probably gonna file a Georgia return if they have income tax. And that the house itself will be reportable to Georgia, because it's a Georgia property.
Right.
Florida property?
Yeah. I said it's really simple.
I like it when it's done. Sincere, thank you. Well, there's no income tax in here. So you're gonna file a federal return to Florida, Georgia. And if it has nothing to do with Georgia, now, if you did it while okay, I'm getting you.
I was living in